Every single hour, around the clock, a facility in Washington, D.C. transforms simple sheets of paper into U.S. currency. These machines operate nonstop 24 hours a day, 7 days a week, pumping over $500 million into circulation daily. Yet, that's just a tiny sliver of the real money supply. The vast majority of modern money doesn't physically exist, it's digital. And that digital figure grows by more than $4 billion every day. So where does all this money actually come from? Before any of it hits your bank account, it's been passed through countless hands, governments, businesses, individuals, all made possible because someone, somewhere, typed numbers into a computer. To truly grasp how today's financial system functions, we need to go way back to a world without money. Back in early human societies, trade was based on trust. If a farmer needed a new tool, he'd go to a tool maker. Lacking anything to exchange immediately, he'd promise payment in the future. The toolmaker, trusting him, agreed. A couple of weeks later, the farmer brought food from his harvest to repay his debt. This informal credit system was the earliest form of money, but to simplify trade, people began using commonly valued items, salt, grain, cattle, things everyone needed, and that were hard to come by. Eventually, metal coins like gold and silver became the preferred medium, durable, portable, and inherently valuable. Trade exploded, connecting distant parts of the world from China to Europe. But carrying heavy gold was risky and inconvenient. By the 1600s in London, goldsmiths offered to store people's gold for a fee. In return, they issued a paper receipt, promising the bearer could claim their gold any time. These paper notes began to circulate as money trusted, not because of their material, but because of what they represented. Then came a turning point. Goldsmiths noticed people rarely redeemed their gold, so they began issuing more notes than the gold they held. These extra notes were essentially money created from thin air, given out as loans and repaid with interest. Suddenly, new money was entering the economy without printing new coins. As long as everyone didn't ask for their gold at once, it worked. Replace those goldsmiths with banks and those paper notes with digital numbers, and you've got our current financial system. Back then, money simply moved around. Picture 4 people sharing $100. Every transaction just shifts that. Money around buying food, hiring services, creating value, but not adding money. Eventually, distribution gets uneven. Some people hold most of the cash and trade slows down. To keep economies growing, we need to inject new money into the system. This speeds up commerce, funds innovation, and drives society forward. But where does that new money come from? Contrary to popular belief, banks don't just store your money, they create money. When you deposit cash, the bank owes you that amount. It's a liability, not cash in a vault. On the flip side, when a bank lends money, it doesn't hand out someone else's deposit. It types new digits into your account. That's fresh money created out of nothing. You use that loan to buy a car. The dealership pays its employees. They spend that money elsewhere. A ripple of economic activity begins, all sparked by digits on a screen. But here's the catch. If more money is created than goods produced, prices rise. That's inflation. To avoid this, central banks must carefully control how much money enters the system. But banks aren't really constrained anymore. If they're short on reserve funds, they can just turn to the central bank. And the process of creating money gets even murkier when we look at the government. To inject money into the economy, the US government sells bonds, essentially IOUs promising future income. Banks, corporations, and even other countries buy them. The funds raised go toward government spending, paying contractors, employees, social programs. But here's the problem. The government constantly spends more than it earns. In 2024, federal spending reached nearly $7 trillion. Tax revenue couldn't cover it, so the government issued even more bonds, deepening its debt. And this cycle repeats year after year. This debt-driven money creation is how most of the modern world functions. It's not inherently bad, it's just inefficient. If newly created money were directed into things that boost long-term productivity like education, infrastructure, or innovation, we'd see far better returns. Instead, money often flows into unproductive areas, creating bubbles, inflation, and inequality. Understanding how money is made, moved, and manipulated is key to understanding your economy and your place in it.